you have a competing product that I want to talk about. You have a private credit CLO ETF, CLO collateralized loan obligation. It invests in at least 80% in collateralized loan obligations. Tell us a little bit about this. How does this work, and CLOs, and why is this a good way to get at private credit?
We think this is the right way to get at private credit right now. Fundamentally, first and foremost, it invests at 80% of its portfolio holdings are in CLOs and invest in private credit. So in contrast to the product we were just talking about, that product doesn't have the moniker of private credit only in its name. It's an investment grade and a private credit product together. So what you want, if you're really seeking exposure, true direct exposure to private credit, your product should invest a majority, significant majority, ours is 80% in private credit debt. So the way ours works is we do use a wrapper, the CLO. If you know anything about ETFs, there's a lot of people that watch your show do, they all know that the ETF is a wrapper to something. ETF wraps 500 stocks in a portfolio and calls it SPY. In this instance, a CLO is a package of loans given to private companies, and those private companies use those loans to operate their businesses. It's lending money to companies just like any other bond that happens in the United States, corporate America. These loans are packaged by professional managers, and they're put into the ETF. So the ETF holds 42 CLOs. Each CLO has about 100 loans in it. And
that's the point there. So each CLO has 100 loans. It's a package.
It's a package.
And you have 42, you said?
42 right now.
Okay.
Yeah. And what you're getting direct exposure to the economics of that loan. You're getting direct exposure to the coupons of those loans and all of those companies. The only difference here is that these companies are private versus public. And so when you package them up in the CLOs and then the ETF buys them, you're really connecting two markets in a powerful way so that there's a lot of liquidity for the ETF on the secondary market for investors that buy the ETF to come in and out of the ETF. And then the underlying holdings themselves are liquid, tradable, priceable. You know, we can price those every day. Our NAV gets priced every day. And it's a robust set of capital markets coming together, and you're getting pure exposure to private credit.
So, and this is our chance to educate the viewers a little bit. When you buy into private credit like this using a CLO, what are you getting? I mean, I'm asking a broad portfolio question. How do you use this in your portfolio? I mean, what place does it have? Okay, I have stocks and I have bonds, I have real estate. I mean, why do I need this in my portfolio? I'm asking a broad generic question.
The net result of that portfolio is on a weighted average basis, an A-rated portfolio of loans and CLOs. The SEC yield on the fund right now, the most recent SEC yield is 7.44%. The portfolio itself is yielding, the coupons underneath that portfolio of loans is yielding over 8%. And then the key here is the duration. It's ultra short duration. This is a 0.25 in duration, so that's 3 months of duration.
Duration is sensitivity
to interest rates.
Right.
So as interest rates...
It's not the same as maturity. People confuse this all the time.
They do. So because they're quoted in years or months. So anyway, the point here is that being so low in duration and interest rate sensitivity reduces and dampens the volatility of this portfolio significantly. So it's very, very low volatility, gives you more price stability to enter these markets that have a lot of uncertainty right now, and we're seeing volatility on the long end of the curve. We're seeing volatility in equity assets. One of the key things here, and this is the part of the hat trick I spoke about, the third thing is all of this together gives you a lot of diversification. You have over 4,000 loans in here, 22 managers wrapped up in this portfolio. And importantly, this asset class, private credit, private assets, is very low correlated to public markets, both equity and fixed income. So it's a true diversifier. So the way you use it,
well, that's important when you're considering how to use it in a portfolio.
You put it in your portfolio to truly diversify. That's why it's such a popular access point.
So you're saying you have more than 100 different loans in each CLO here.
Yeah.
Now tell us what the risks are. Where will this go south, or what? Explain what the issues are here, in terms of the risk.
Yeah. So you think of a CLO like a bond. It has a CUSIP, it has a coupon. Underneath that, there's exposures in that CLO. like I said, there's 100 loans in each CLO, and there's 42 CLOs. So you have exposure to 4,000 loans. There's a lot of diversification there. Some of those loans could default. In the past, we haven't seen, broad defaults in CLOs, and they've been a very stable place in terms of defaults over time.
So it's a credit. I mean, the principal risk is non-payment, right?
Yeah,
Isn't
the principal risk
sort of
is
the obvious?
non-payment, and that can happen. But you're in a portfolio with a lot of diversification, and that's sort of the beauty of not only the asset class it being so low correlated to public markets, but also the portfolio itself is very
What
diversified.
kind of loans are we talking about? I mean, it's easy to just sort of broadly say, but what kind of what's the loans?
So we're loaning to companies that are middle market. That's defined as small to mid-cap companies. Their EBITDA is less than 100 million. They're companies that are, operating privately because it's probably easier from a regulatory standpoint to do so. It's also, they're at a stage of their growth where their performance...
And they could be anything.
It could be anything. It
could be industrial technology. I mean, literally, I'm just trying to get a sense of what's a typical
company. Satva is a mattress company that builds mattresses and, markets them to the retail public. It can be across all industries. And I think the really interesting thing is that we're talking about 300,000 companies in the United States. This is a really important segment of growth in the United States, and you just don't have access to it. But these are, small companies. Yeah.
So Todd, let me bring you in here. Be the guru here. I always say when I see this happening, the world rushing to private equity. And private credit like this. There seems to be this mad rush to do it. I always ask myself, is this peak? Fill in the blank. Is this peak whatever? Right. Is this peak private credit? Are we in the late stages of the alternative credit cycle, or am I just being a little too professorial here?
Wall Street is great at making supply of something when there's demand. Supply.
Oversupply.
Oversupply. We've seen it happen time and time again in the ETF industry. The distinction is on the quality of the product, right? So I can look up the CUSIPs in Joanna and Baumblocks' product and understand what's in the ETF. I look at this new ETF from State Street, and there's about 7 holdings in there that I can't even Google. I Google it, nothing's there. Good luck finding out what you own and what the risks are there. So I have a problem with putting really opaque assets into the ETF. When there is information there, then I say, okay, we're not at peak private credit, but perhaps peak opaqueness. Maybe that's the right phrase to think of it here. Like there would be room for things like what Joanna has, where it actually makes sense for diversification. But when you start putting assets without any sort of paper trail, understand what they are.
Well, how does the creation and redemption process work? If you have to buy more or sell more of these CLOs, how are you obtaining them?
There's a robust market for CLOs, a secondary market. Essentially, these are loans that have been repackaged, from managers like Ares, Blackstone. They've made their initial loan, they repackage them, and they sell them again. So there's a robust secondary market to buy these CLOs. Our portfolio is, as defined by the SEC, has a very liquid profile in terms of basically, our portfolio managers can go out and add more CLOs or sell more CLOs as needed. In this case, the creation redemption process is in cash. A lot of funds in fixed income operate that way, and there's been a lot of innovation because the whole category in CLOs and ETFs is bigger than just this private credit ETF, and that's getting to be closer and closer to what the technical side of in-kinding is happening. So the markets are connecting and they're developing together, and they're facilitating this overwhelming demand in CLO exposure and ETFs that use them.
Todd, I'm wondering, I brought this up last week on Halftime Report, and people were saying about whether or not there was a simpler way to go out and do this. We had talked about this last week. We were talking about private equity, and one of the things that you could do is you don't necessarily want to buy the private equity. You want to buy the private equity companies, not their products. So, you want to look at, KKR, for example, or there's some ETFs that invest in PSP, which is the Invesco Global Listed Private Equity. They actually invest in like KKR,
right?
Which is the company that actually goes out and tries to deal with these companies. They invest, Ares Capital, they do deals with small and middle market companies directly. There's different ways. My point is there's different ways to attack this. And it's fairly complicated to figure out, if I want exposure to private equity, how do I get it? There are different ways to go ahead and do that.
The easiest route is through listed private equity names, right?
Yeah, KKR, for example.
KKR, PSP, PEX, I think is the other one.
Yeah,
That's
Ares,
the simplest
Capital,
route.
ARCC.
The other way, if you're an investor, is, okay, if I want SpaceX, well, buy a company like Rocket Labs, or buy an ETF that has the space theme in it, because they'll probably trade like SpaceX, or whatever other, credit. If there's a credit card name like Klarna out there, you can go that route too, to get the benefit. I'm not a fan of the ETFs out there that have the private assets in them that don't get valued every day. I think that's a little odd and against what ETFs have been about, which is transparency and liquidity. So I think you just have to look for the parallels to what's out there, right? And go through the ETFs that have the exposure to that category.